What's going on, guys? So lately I've been making an observation that a lot of short traders are basically getting destroyed, right? We're seeing a lot of new participants in the markets over the last 2-3 years after this COVID boom. And naturally, if there are more people playing the long side, in my opinion, there will be more people playing the short side. So if you are a short bias trader, you have to be well aware of this, because in small caps especially, this is how we see these massive moves, right? Forced buying, also known as short squeezes, right? We know that the more participants that are short in a market, the bigger we can see a potential squeeze, or the higher likelihood of there being a squeeze is what would happen. So knowing that and taking into consideration that 90% of traders fail to be consistently profitable, you have to think like the 10% who are actually making money. In my opinion, it's more like 2 or 3%. So in my particular case, as a short bias trader, I'm not trying to predict the whole move. I'm not trying to capture the top to the bottom. My goal is to just catch a piece of the move and be consistently doing that while managing my risk. And a lot of traders are coming into the markets and, in my opinion, for ego purposes, are trying to either catch the top or catch the very bottom. And we're seeing a lot of blow-ups happen, or a lot of small losses repeatedly happen by having that habit. So one way that I try to not think like the majority of traders who are in the markets, which is ultimately how you have to think, is I try to capture my profits within a short span of time. If you have the discipline to do so, trade the first 1 to 2 hours and then leave your screens and then come back in the second half of the session, or even just the next day. In my opinion, you greatly increase your chances of staying consistent, right? If you look at the Pareto distribution or the Pareto principle, it states that 80% of the outcome comes from 20% of the cause, or the causes. So for a business example, 80% of your sales would come from 20% of your clients. And the way that I see it in trading is 80% of your profits come not only from 20% of your trades, but 80% of your profits come from the first 20% of the trading day. And that's essentially how I think it's important to not think like the masses. You come into the markets, you find the range, you know when the emotions are high, you take your profit and you leave. Because if you sit there all day, and if you understand the participants in the markets, these algos, these short bias traders, these long bias traders, and if you're a short bias trader and your window of opportunity has disappeared, yet you're still trying to capture more move and trying to squeeze more water from a rock, in the end, over thousands of trades, you will get blown out. So it's very important to enter the markets and do essentially the opposite of what most people are trying to do. And notice what most people are trying to do, so that you can get a better picture of your trade, have a clearer trade thesis, and enter and exit the markets in fashion.